This is the 5th analytical episode in this channel's archive, and the one that connects the institutional patterns documented across 69 individual case files to the single systemic event that tested, validated, and in many cases catastrophically exposed every one of those patterns simultaneously. The 2008 global financial crisis. Every analytical framework this channel has developed, the hotel bankruptcy anatomy documented in case file 060, the private equity Grand Hotel acquisition playbook documented in case file 061, the trophy asset trap documented in case file 068, and the construction loan trap documented in case file 069 describes a mechanism whose individual instances occur continuously across the commercial real estate market under normal conditions, producing the steady stream of individual bankruptcies, foreclosures, and restructurings that this channel's 70-case archive has documented across multiple decades. The 2008 financial crisis was different. It was the moment when every one of those individual mechanisms activated simultaneously across the entire American commercial real estate market, producing a systemic event whose scale and synchronization no individual property's debt structure, however carefully analyzed, could have anticipated in isolation. This episode examines the specific financial infrastructure that connected the individual property-level failures this channel has documented to the broader systemic crisis, the commercial mortgage-backed securities market, whose securitization structure had transformed individual commercial real estate loans from bilateral relationships between borrower and lender into tradable financial instruments distributed across a global investor base, and whose specific structural characteristics determined which buildings survived the crisis, which buildings failed, and which buildings were left in the protracted limbo of unresolved distress that characterized the years following the crisis's acute phase. The Troubled Asset Relief Program, the federal government's emergency intervention, addressed the banking system's solvency crisis, but was not structured to directly address the commercial real estate market's specific distress, a gap that this episode examines in detail. The buildings that were left behind, properties whose distress was severe enough to require resolution, but whose resolution mechanisms were inadequate to the scale of the crisis, are the specific forensic subject of this episode. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The commercial mortgage-backed securities market that had developed across the 1990s and 2000s transformed the relationship between commercial real estate borrowers and lenders in a way whose specific structural characteristics determined how the 2008 crisis's stress was transmitted through the system. In the conventional bilateral lending relationship that characterized most of the case files this channel has documented from earlier decades, a single lending institution held the loan, maintained the ongoing relationship with the borrower, and had both the institutional capacity and the direct financial incentive to negotiate covenant waivers, forbearance agreements, and restructuring terms when the borrower's financial performance deteriorated, because the lending institution's own balance sheet bore the direct consequence of the loan's eventual resolution. The CMBS structure fragmented that relationship. A commercial real estate loan originated for CMBS securitization was pooled with hundreds of other loans, structured into tranches of varying seniority and risk, and sold to a global investor base whose individual holdings represented fractional interests in the pooled cash flows rather than direct relationships with any individual borrower. The covenant that the CMBS market's structural design did not adequately address was the one embedded in the relationship between securitization's efficiency benefits, lower borrowing costs achieved through capital markets access rather than balance sheet lending, and the loss of the direct lender-borrower relationship that effective forbearance and restructuring negotiation requires during periods of financial distress. When a CMBS-financed property's borrower experienced financial distress, the borrower could not negotiate directly with a single decision-making lender. the borrower had to negotiate with a special servicer, a specialized entity contractually responsible for managing distressed loans within the CMBS pool on behalf of the bondholders whose interests were aligned with maximizing the pool's aggregate recovery rather than with any individual property's specific circumstances. The special servicer's institutional incentive structure, compensated through fees tied to the resolution process rather than through a direct ownership stake in the property's long-term performance, created a specific institutional dynamic that this episode's analytical framework identifies as structurally distinct from the conventional bilateral lending relationship that this channel's earlier case files document. At what point does the efficiency gained through loan securitization create a resolution mechanism inadequate to the relationship-based negotiation that financial distress requires? Leave your analysis in the comments below. The appraisal methodology that supported CMBS loan origination across the 2005 to 2008 period, the years immediately preceding the crisis, documented a systemic optimism bias whose scale and synchronization across the entire commercial real estate market this episode's framework identifies as the aggregate expression of the individual appraisal failures. This channel has documented across dozens of specific case files. CMBS loan origination volume grew dramatically across this period, driven by investor demand for the yield that CMBS securities offered relative to other fixed income investments in a low interest rate environment, creating origination market conditions that prioritize loan volume over underwriting discipline in a pattern that paralleled, at vastly larger scale, the savings and loan crisis dynamics documented in Case File 056. The specific appraisal failure that CMBS origination shared with the savings and loan crisis was the treatment of available financing as evidence of market demand, rather than as evidence of the originator's institutional incentive to generate loan volume for securitization, producing stabilized income and capitalization rate assumptions across thousands of individual commercial real estate appraisals that systematically understated the risk that a broad-based market correction would simultaneously affect the underlying collateral value of properties across every geography and property type in the CMBS market. The specific difference between the CMBS era appraisal failure and the savings and loan era appraisal failure was scale and synchronization. The savings and loan crisis's overbuilding was geographically concentrated in Sunbelt commercial real estate markets and unfolded across a multi-year period that allowed some sequential institutional response. The CMBS era appraisal failure was distributed across the entire national commercial real estate market and was synchronized by the common securitization infrastructure and the common low interest rate macroeconomic environment that affected every CMBS loan origination simultaneously. When the 2008 financial crisis triggered the broad-based commercial real estate value correction that the CMBS era appraisals had systematically underweighted as a risk scenario, the correction's impact was not isolated to specific properties or specific geographic markets. It was distributed across the entire CMBS market simultaneously, producing the systemic crisis whose scale exceeded what any individual property's appraisal, however accurately conducted in isolation, could have anticipated. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The Troubled Asset Relief Program, enacted by Congress in October 2008, was structured primarily to address the banking system's solvency crisis through the purchase of troubled assets and direct capital injections into financial institutions, a structure whose design reflected the federal government's assessment that the banking system's stabilization was the primary policy priority required to prevent a broader economic collapse. TARP was not structured to directly address the commercial real estate market's specific distress at the property level. The program's resources flowed to financial institutions whose own balance sheets held CMBS securities construction loans, and other commercial real estate-related assets among their broader portfolios. But TARP did not create a direct mechanism for resolving the specific covenant breaches, forbearance negotiations, and restructuring processes that individual, distressed commercial real estate properties required. The institutional gap this created between the federal government's banking system stabilization priority and the commercial real estate market's property-level resolution requirements produced the specific phenomenon that this episode's title identifies as the buildings that were left behind, properties whose distress was severe enough to require resolution, whose CMBS financing structure made that resolution institutionally difficult through the special servicer mechanism this episode has already examined, and whose resolution timeline extended years beyond the crisis's acute phase, because no policy mechanism existed to accelerate property-level resolution at the scale the crisis had created. The institutional denial embedded in this gap was not located in any individual policymaker's failure to recognize the commercial real estate market's distress. The gap reflected a deliberate policy prioritization. The assessment that systemic banking system stabilization was the more urgent priority, with commercial real estate market resolution expected to follow through the gradual recovery of credit market conditions, rather than through direct policy intervention at the property level. That prioritization was defensible as emergency crisis policy. Its consequence was a multi-year period, extending well into the 2010s for many CMBS-financed properties, during which buildings whose distress had been triggered by the 2008 crisis remained in unresolved limbo, their special servicers managing extended workout processes whose pace was determined by the CMBS structure's institutional incentives rather than by any urgency to restore the properties to productive economic use. The specific buildings that this episode's analytical framework identifies as having been left behind by the 2008 crisis's resolution mechanisms are documented across multiple individual case files in this channel's archive. Properties whose financial distress originated in or was severely worsened by the 2008 crisis and whose resolution extended years beyond the crisis's acute phase. The Xanadu Meadowlands, documented in case file 032, experienced exactly this dynamic. Its construction financing collapsed during the 2008 crisis, and the project remained partially constructed and visible from the New Jersey Turnpike for years before a subsequent developer transition eventually completed the project a decade later than its original timeline had projected. General Growth Properties, documented in case file 031, experienced a different version of the same dynamic. A portfolio of genuinely high-quality, profitable shopping malls whose debt maturity concentration, structured through CMBS and other commercial real estate debt instruments, made the company unable to refinance in the credit market conditions the 2008 crisis produced, despite the underlying assets' continued operating profitability. What the 2008 crisis case file reveals in the context of this channel's 70-case archive as the fifth analytical episode connecting the patterns documented across the preceding 69 individual cases is the specific moment when every mechanism this channel has documented activated simultaneously. The trophy asset trap's capitalization rate compression, the construction loan trap's timeline, dependent vulnerability, and the conventional debt service coverage ratio. Covenant breach mechanism, all triggered across the entire commercial real estate market by a single systemic credit event, whose synchronized impact exceeded what any individual property's risk analysis could have anticipated. The crisis didn't create new mechanisms of institutional failure. It activated simultaneously and at unprecedented scale the same mechanisms this channel has documented across decades of individual case files, demonstrating that the patterns this channel's analytical episodes have identified are not merely descriptive of isolated historical incidents, but are structural features of the American commercial real estate finance system, whose individual manifestations this channel has been cataloging one building at a time. If this case file changed how you evaluate systemic risk in commercial real estate finance, subscribe, because the next case returns to a specific building whose own story embodies the broader patterns this analytical sequence has established. And in the comments, given the documented gap between TARP's banking system focus and commercial real estate's property-level resolution requirements, what specific policy mechanism would have most effectively accelerated property-level resolution without compromising the broader financial system stabilization priority? The case file is open. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication. Factual claims, interpretive framing, creative direction, and final content decisions reflect human judgment throughout. This disclosure is provided in accordance with platform transparency standards for AI-assisted content.